Hello traders, what's going on? This is Prof from Forex Academy speaking. I want to welcome you back to the channel. If it's your first time on this channel, make sure you hit that subscribe button and turn your notifications on so that you don't miss any of the content that we'll be uploading on this channel. On this channel we talk about BTMM, we talk about ICT order blocks, we talk about institutional order flow, we talk about smart money concepts, we talk about Elliott wave, we talk about the nature theory, we talk about market structure, everything that is of interest to you in those areas. I'll be touching on important concepts from time to time. Just make sure you subscribe to the channel so that you don't miss any of that content if it's of interest to you. Also, I also do live market analysis, especially during weekends, for a week, which will be weekly market analysis for volatility indices and for currencies. So if that is of interest to you as well, you might need to consider subscribing to the channel and turning your notifications on so that you don't miss any of that content. If you need to contact me, you can join my Telegram groups. I've put links in the description below. Just make sure you join those Telegram groups and the WhatsApp group as well for free market analysis setups. From time to time I send free analysis in those groups. You can as well take advantage of those to increase and improve or to give you an extra eye rather to market perceptions, sentiment and views. So that's all I can say about that. So today in this video I'm going to talk about order blocks. So the order blocks that we are going to discuss today, we are going to discuss number one, the mitigation block. We're going to discuss what we call a mitigation block. Then later on we'll go to the charts and see how you can trade a mitigation block. We're going to talk about a breaker block as well, and then we'll also go to the charts and see how you can best trade a breaker block. We'll also talk about the other two order blocks, which is a reclaimed order block and a rejection block, and just to check out how best you can also trade those and how do they occur, or are they really of interest to you to start with. So without wasting your time, let's go to what we call a mitigation block and how best you can take advantage of that kind of an order block. So I've two diagrams that I've drawn here. I have this first one and this second one. So what I'm going to do is this one is going to explain what happens if we're going into bullish momentum, and the opposite is going to apply if we're in a bearish momentum. And this diagram is going to represent what I call a mitigation block. Then if we look at this one here, this is going to represent what we call a breaker block, and I'm going to explain how this occurs and how you can trade this kind of a market pattern or a market setup. Okay, so let's start with a mitigation block here. So a mitigation block in this diagram here, I'm showing the market as it is going down. So we are in a bearish momentum. So if we're in a bearish momentum, you know how the market will be trending. It will be giving us these lower highs, lower highs, lower highs as we go down with the trend. So what happens is, if we are trading this trend as we are going down, obviously there are going to be people who are going to trade this market, we're going to sell, we're going to go short on this point going downwards. And also as the market comes back, the sellers are going to see an opportunity again to join the trend and sell the market to the downwards so that they can hold their positions into profit. But sometimes it happens that the market will not necessarily give you a further lower low. Rather, the market will then change direction, like what I've indicated here. As it changes direction, it will give you this W-like shape. Then the swing low, which would have the swing point, which would have been which would have been created here, would then be violated by price action going to the top. And as this price action is violating this one, what we are looking to do is to wait for price to come to this point. Let's talk about the reasoning behind this market philosophy. Why are we expecting price to then come back to this point, to retest this point? Why should we trust that the price will react at this particular point here that we are indicating as a market structure shift? So in this case, we are simply saying it's a market structure shift because the market structure was trending downside, and all of a sudden it has changed direction, is now going upwards. So this point where price has failed to create a lower low, rather it has come back to create a higher high, is what in such a way that you now have a higher high, a low high, a high as you go. This point is what we're calling what? A market structure shift. So why are we expecting price to react at this particular point and not necessarily at this point or at this point for it to come back? What is happening is there are these guys here that we have agreed that they have taken their positions going to the downside. So what happened is we had sellers at this point who took trades. So there was an order block, so or there were volumes here of a bearish of a candle that people used to sell their positions to the downside. As they sold their position to the downside, they were expecting to get profits as price continuously goes low. But all of a sudden, price turned at this point. As the price is coming back, if you don't have a stop loss here, what is going to happen is this price is going to take you deep down into deeper losses. And as you get into deeper losses, when price comes back to this point, what you're going to do is you are going to try to mitigate from the word mitigation block. You're going to try to mitigate your losses here. So if you're going to try to mitigate your losses here, what are you going to do? You're going to release all the positions that you had when you were going this side. So if you release these positions that you had here, so the market to balance is going to cause the price to go back. It might go back to just take out this high that had been created there, or it might go back continuously going downwards. Now this is now coming into account, taking into account the confluence of where the market is telling you where is a market structure going, where is order flow going. It's now the concept of order flow now to then tell you whether the price is going to continuously go low or it's going to just go and take out this high or retest this high before it comes back. So if these guys are going to release their positions here, price is going to be forced to even go this side. As the price goes this side, this is where you will be profiteering now from the trade that you would have taken from this swing low that has been violated. So this is what we call a mitigation block. So what you need to do is you simply to identify, if you're in a position like this, you would want to identify where selling has taken place. So where selling has taken place is your bearish candle at this market structure break, at this swing point. There will be a bearish candle that will be given here. That bearish candle is where the selling took place. So since this is where the selling took place, you would expect when price comes back that they would liquidate the selling that took place in this block that you, or this candlestick that you're given here. So this bearish candle that is at the market structure shift is what we are calling a mitigation block. And for that mitigation block to be valid, it should not be traded. It still uses the rules of order blocks that we talked about in the first video. If you haven't watched that video, guys, you might need to just go and check out what we talked about in that video. It might be helpful as well for you. So what is going to happen is we wouldn't want them to trade through the midpoint of this block that you're given here. What we just want them to do is to retest this block and then they go upside. You're going to see that as we go also into the charts, you're going to be, before they break this swing low, normally they leave an order block somewhere around at this point. Normally before they break this low, they leave an order block somewhere around this point. This order block that you're seeing here is what we call a reclaimed order block. We'll talk about a reclaimed order block as we go. But remember also we talked about a propulsion block, so you just need to check whether it's a reclaimed order block when it's inside, or it's just a propulsion block, which is also taking the other blocks that will be coming from this side into account. This is what we call a mitigation block, guys. Remember, you need a swing low, you need that market structure break, and then coming back to test the market structure break to the upside, targeting the first swing high as your take profit number one, depending on where order flow is going, depending on market structure. We also did videos on market structure on this channel. Again, you can go and watch those. Then you use market structure that resonates well with you, or you get the confluence of everything if you can digest the information into yourself and use it also, or add it into your trading library. So this is what we call a mitigation block. Let's just talk about a breaker block, and then we compare and contrast and see what's the difference here. So if you are looking at this in a bearish momentum, if you just transpose this, and it then becomes the same thing when you are going bullish, when price going bullish, then it breaks market structure to the lows, to the sell side. So here I've used an example where we are in a bullish momentum. Price is making a series of high highs as it goes upside. Then what happens is, what this line is representing is, it is representing an area where liquidity lies. Liquidity will normally lie where there are equal highs, where price has previously psychologically created a point where people can put their stop losses. That point where people can put their stop losses is what we are calling where is where liquidity will lie, because people will just measure 10 pips, whatever your strategy tells you to put, then they put their stop loss above there. What price will do is it will come to seek these stop losses so that it takes out these people that are in a sell out. So what is going to happen is, this movement is going to be a very fast movement, which is going to take out this high. As it takes out this high, you are watching and you're out, you're not taking any trade, you're just waiting for them to take out this swing point. You are waiting for them to take out this swing. Let's just correct this to a swing point, shall we? Let's call it a swing point. Okay, there we go. Perfecto. All right, so what you're waiting for is for them to then commit to the downside to show you that the trend has changed. So what you're waiting for them is to break the structure. We are looking for a breaker there. They should break structure. So a breaker would have made a higher high. Here it has shown you that it's failing to make a lower low. But in this case, it would have made a higher high. If we were in a downtrend like this, if we are talking of a breaker in a downtrend like this, it would have made another lower low. It wouldn't have failed to make okay, it would have made a lower low if we're talking of a breaker in this case. It's different from a mitigation block, which would have failed to make a lower low to show you that we are changing trend. With this one, it will go quickly to the top there and grab liquidity. It has shown that the trend is continuously going, but now as they go down to break this point here, this is what we're calling a breaker. So on this point here, we are going to have a down close candle, and that will be here. That candle is what we're going to use as our entry point. As the price is going to come back to test the midpoint here, that's where we then take our our trade to the low side, we'll simply be targeting this low, depending on order flow. Where is order flow going? Where is the market? Where are we being directed by the market structure? Where exactly are we going? If you can predict using the higher time frame, of course, where we are going, then you can simply hold the position. But if you cannot necessarily predict, then this swing point becomes your take profit. Then you are out. You just take that and you are out. All right, we'll explain more on how to take trades as we go through our charts, our live price charts, to see how you can identify that on live charts and how you can use them. All right, so this is the breaker block, this is the mitigation block. So everything I have explained on this breaker block will also be the same thing as we talk about here, where we are talking about the lower time. When it's now transposed, and we are talking about the bearish or the downtrend, and we are going to the upside. So we are waiting for market structure break. That swing point, it has to be broken to the downside. Then with price going to retest again, you're going to see that in lower time frames, in most cases, before they break this swing point, because they want to trade buys, because they want to trade. You remember, these people are into making money as well. This is business, ladies and gentlemen. So before they do this, normally they will start giving you bullish candles there, so that they trap you into buying. And by the time you buy, then they will take your money to the downside. They will then hit your stop losses. They go to the downside. They will be inducing you to think that probably maybe we are just having a double bottom there and you are buying, when you are actually in a downtrend and they are about to break. So what you're waiting for is to for break of structure, then a retest to the upwards on that swing point, on that neckline to the downside. That's how you trade your breaker there. So if you compare and contrast these two shapes there, they are almost similar to what you call a double bottom and a double top. The exception is that instead of these being equal, they are not equal. In a breaker, this one, the second leg is bigger than the first leg, because you're still in an uptrend and you are continuously having higher highs. And in a mitigation block, this one is lower, the second leg is lower than the first one, meaning to say that you were in a downtrend and you failed to make a lower low, confirming a change of trend. Then you took out that swing point, further confirming a change of trend. Then by the time you retest this point, it's even a better trade to take it to the upside. This is what I wanted to explain about a breakup block and a mitigation block. So this is of interest to me as well. As we talk about in the first video, we talked about how you can trade an order block. Also, if you check in that video, we were simply saying that you wait for price to come to your order block. The order block that would have been created here when let me change the color of this arrow so that you can easily visualize what I'm talking about. So I've made it blue there. So as the price was coming to the downside, from this low here, when it breaks structure in lower time frame, it's going to show its willingness to go up. It's going to show its willingness to go up. So what we said is the price is going to come to the last down candle which was left here. When price comes to that last down candle, that's where you're going to buy. So you'll be buying from this point. Obviously, this will not be the breaker situation. It will be the mitigation block situation. So you're going to buy from this point here. What's happening now? Okay, you're going to buy from this point here, expecting price to go to the upside. You are going to buy from this point, expecting price to go to the outside. Let's say for example, you miss this point here. Let's say you miss this point here, you miss your order block here. How can you join this trade? If you miss your order block here, how best can you join this trade? Well, you don't need to worry. Number one, if you miss the trade or you're a conservative trader, you just don't want to, you just don't trust these order blocks, or you're new to order blocks. This is your first time, you want to try out order blocks, you don't know whether they work or they don't, you just want to be sure, at least you need to have many confirmations that the trend has changed, and you want to also to join the trend in using these order blocks. What you can simply do is you need to check whether price respected the order block here. If it respects the order block here, they should take out the structure that would have been created when price was coming back to test the order block. Then after they do that, you want now to identify your mitigation block at this point now, so that you can also join the trend. So on this mitigation block, as the price is going to come back to the mitigation block, that's where you then trade your trade as you go to the upside. Also, if you are trading that order block, the same order block we talked about in the first video, what you can simply do is you can, as you see price testing the order block like this, you can go to the lower time frames. For example, you can go to M5, you can go to M1, then you look for this information on the lower time frames on M1. So if you are going to go down to M1 or M5, then you look for a mitigation in M5, for a mitigation block in M5. So what you'll be looking at is you want to look for, number one, a swing point. Then after that swing point, you want to look for what? For market structure break. You want to look for break of structure like that. So after that break of structure, what do you want to see? You want to see an order block here that will be, or here that will be responsible for this break of structure. Then as the price is going to come back to test that order block, you then join the trade with everyone else. And it's also used when you want to scale in your positions. If you have entered positions here and the stop loss is down there, you can enter more positions there. Then you put your all your stop loss. You move this one to your entry point. Then you also, for the sake of this, you also put your stop losses here for the trades that you have joined here. So this is how you trade your mitigation block and your breaker block. Okay, for practice now, let's go into the charts and see how best you can trade those, how you can identify them, and how you can trade them on live price action. Okay, so what do we have here? I'm looking at the V75 daily time frame. So what we're going to be doing is we let's do it this way. So we want to identify mitigation blocks, breaker blocks. Okay, so if I check my price here, price is going down, price is going down, price is going down. Okay, but all of a sudden there was this swing point here. Or let's start, let's just start this price together well. So there were these lows here. What did we say? So there is liquidity down here. Okay, there is liquidity down here. So what the price is going to do is, the first time they came, they didn't take out the low, they went upside. They came again, they well, kind of, but they didn't really take out the low. Then they went back again. Then they come deep into that low before they could reverse. So in that situation, that's where we said we are going to have our what? Our breaker block, for example. So this point here is a swing point. Remember, we need the swing point. So as the price is going to come back to retest this swing point, as price is going to come back to retest this swing point, that's where we are having our breaker block. So we would want to join this trade after they've taken out the swing point. We would want to join this trade as price is coming back to retest this swing point. That's a breaker block for you. What about the mitigation block? What about the mitigation block? We said the mitigation block happens when price is continuously going up, then it goes down to have this swing point, then as it goes up, it fails to take out the previous high. So what happened is, as this price was coming to the downside, there were some guys who also took some trades here. So because they took some trades here, where are the volumes? The volumes are in this candle here. So this is where the volumes are. So as the price is going to come down, it's going to come down and take these guys out. If they don't have stop losses, they are going to be in deep losses as price comes to this point. So as price comes to that point, these guys will be in deep loss. So as price comes back to this swing point, this swing low, as price comes back to this swing low, these guys who have taken buys are going to release their positions. They are going to mitigate their losses at this point. So as they mitigate their losses at this point, it's going to force price to go down to at least take out this previous low. It's going to force price to go down to at least take out the previous low. So your entry is going to be in this region where they have this in the body of the candles where they would have taken their buys. So they took their buys in this body of the candle. So what you then need to do is to just to go to lower time frames and find an order block that is on this point. And then we also said that before the price breaks this swing low, in price action they will normally leave some candles here. They will normally leave some opposite. If it are in a down momentum, then some bullish candles here. So as they leave these bullish candles here, this is what we call a reclaimed order block. These let me just identify reclaimed order blocks. This is a reclaimed order block. 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 So these reclaimed order blocks as well represent, or they give us an opportunity to join the trend. If price revisits like this, then it's testing the swing point and as well coming into this reclaimed order block. You can safely add your positions here, just targeting this swing point. If order flow is telling you to go deeper, then you can go deeper. And as the price is going to go down, sometimes to continuously come back to retest the breaker. You can see price come back here, but it didn't really reach the breaker. But we can look for situations where price came back to take out the breaker. Let's just go to H1 and see if we can have more examples there that we can look at for mitigation blocks and breaker blocks. Okay. Right. So there we are. We have our mitigation block there. Did price came back to retest? Let's just check. This is our region. Price didn't quite reach that point. Price didn't quite reach that point. Even the reclaimed the block, it didn't quite reach that point. So you wouldn't have taken that trade. You would have used other strategies or other information to take advantage of that trade. But look at this breaker block here. Price created a low, then it created another higher high. So what happened is, as it created another higher high, it came down to take out the swing point that had been created here. Did you see? Okay, there was this low, and this low which had been created. For you would have probably the triple bottom. Maybe you are still in a buy. Then you would have taken a buy here going to the upside. What would then have happened is they would have then taken you out if you have a stop loss there. But if you don't have stop loss, you will be in deep loss. So what will be happening is, as the price comes back to this point, you will then see an opportunity to mitigate or to reduce your losses rather. So as you reduce your losses there, price as it trades into that, it's going to force price to take out this point here. Then you just take your trade targeting this low there, and as you go to the downside. Did you see some? Are you noticing something here? The raw price action that you have here, where you have this low, this low, this low, then being taken out, is the same price action that you were given on a daily time frame, where you had where is that low? Oh yes, where you had this low, and this low being taken out like that. It is the same thing that we are witnessing on H1. That simply means that these things happen a lot. They recur. They occur more often than not. You can take advantage of these breaker blocks and mitigation blocks. You can also take advantage of them to just improve your trades, to just better your trades, also to improve the order blocks, the quality of order blocks that you can use when you are trading these things. So we were here explaining the price action that we are given here, that the same price action that you have here is the same price action that you also have on a daily time frame. So after the break of structure, here, what are you waiting for? You're simply waiting for price to come back to retest the break of structure. Then you enter your trade. Then you hold. It's that simple. It's that simple, ladies and gentlemen. You're simply waiting for price to come back to retest the break of structure. When they retest and give you the rejections, why not join? The same thing is given here again. Let's just check what we have here. Right, so price was continuously going down. All of a sudden, it then broke this swing point. So we have a swing point here that was broken, going to the upside. What are you waiting for? You're just waiting for price to come back to retest this swing point. Then you join them going to the upside. It is the same thing. It happens over and over again. It happens over and over again. It happens over and over again. Again, you're in a downtrend there. What happened? They took out the swing point. They took out the swing point there. Okay? They took out the swing point. Then after taking out the swing point, what are you waiting for? You are waiting for price to just come back to retest this swing point, the order blocks that were left on this swing point. Then you join the trade to the upside. That's how you trade your breaker and mitigation blocks there. That's how you trade your breaker and mitigation blocks. So where will be your stop loss? Where will be your stop loss? In this case, if you have a reclaimed order block here, what I do when I'm trading these order blocks, if I have a reclaimed order block here, I would want to reduce this reclaimed order block into lower time frames, because half the time they will come to retest the reclaimed order block, because the reclaimed order block normally will be trading into the breaker block that you be given there. So if you have a reclaimed order block, you can simply use the same rules that we talked about when you're trading an order block in the first video to then utilize that. So for example here, if I'm trading this one, I'll wait for them to trade into this order block that I'm given here before they break structure. This order block that I'm given before they break structure. That's what I'm saying, a reclaimed order block. So as they come back to that order block, I'm simply going to take my trade at this point. Okay, I'm going to take my trade at this point. Why? Because already they have broken a structure there, and this is a retest of break of structure. So after they retest the break of structure, where is my stop loss? My stop loss is here, just below the body of that particular candle. Why is it below the body of the particular candle? Because we agreed in the first video that this price should not trade through the mean threshold of this candle and close there if this is a good order block. If price trades through the mean threshold of this order block, then this is not a good order block. That should be a sign for you that you're in a wrong trade. This is how you trade your mitigation blocks and your breaker blocks. If you have anything that you need me to explain more on, don't forget to put it in the comments below, or you can contact me using those methods that I've just told you about. Thank you very much for watching. I'll post the next video probably next week. Make sure you turn your notifications on and don't miss out. I'm out.